For more on mortgage rates and the economy, we're joined by Anthony Chan, former Chief Economist, JPMorgan Chase, this time coming to us from Honolulu. Hey, Anthony. The last time we spoke, mortgage rates have dropped a little bit since then, but at the same time, home prices have also come down. Let's start with why mortgage rates have pulled back from its highs.
Well, the reason why mortgage rates have pulled back is because there is some growing expectations that we are getting close to the peak in prices or inflation, and that means that the 10-year Treasury rate has been able to come down on the expectation that maybe the Fed doesn't have to raise rates as aggressively as some people thought as recent as a month or a month and a half ago. And mortgage rates are tied to that, so they've come down a little bit, but compared to last year, they're up significantly, up over 2% from where they were. And for that reason, we see that home affordability from a year ago is still down about 40%. So we still have some challenges, despite the fact that mortgage rates are off their peak in mid-June, on June 14th. In fact, my birthday, when mortgage rates actually peaked, I remember.
Well, if you look at a chart, okay, of home prices in America, and you'll see a huge spike, okay, post-pandemic. And it's a massive spike. And I don't know if you heard the guest earlier, but anywhere between, say, 25 and 50 or 60 or 70% is the increase since the pandemic began. And that was when rates were very low. We lowered the rates. Now we've raised the rates slightly, in some cases, you know, to 5.25%. But the home prices, they've pulled back only a little bit. Now, as a regular person, I look at it and I say, well, does this mean that all these gains that we made for the last 2 years have to pull back, or how much do we pull back, or how much do we give back?
The reality, Phil, is that we're going to give back only a very small fraction of it. If you look at many different measures of housing prices, I recently wrote a Substack article on this topic. If you look at Case-Shiller, for example, those prices from the bottom of the pandemic are up over 40%. And we've given back a few percentage points. But the real key, Phil, is that if you look at average hourly earnings and you look at housing prices, you basically see that housing prices have grown close to 3 times faster than wages, which explains why home affordability is such a challenge, and certainly a challenge for people that are working and don't rely on wealth for their down payment, but rather their wages.
Right, and you know, people forget owning a home isn't what it used to be. Everything costs more, from fixing one plug, one electrician, one roof leak. Everything feels like it's 3, 4, 500% more, and just in maintaining the house. So it's not, I don't think, such a slam dunk, hey, let's own a house and everything's going to be great and we're going to make a ton of money.
That's exactly right.
So how to make homes more affordable?
Well, the way to make homes more affordable is to ease zoning laws so that more land is available. Because right now, what we have, Phil, is a shortage of inventory. When you look at existing home sales, which are about 90.5% of all the houses in the market, the inventory is 2.9 months. The normal is 6 months. It's only when you look at new home sales that hits the headlines that you see a 9.3-month inventory. And people say, oh, does that mean that we're above 6 months? Yes, we are. But that is only 9.5% of the market. The other 90.5%, you have close to 50% less inventory than you would in a normal market. And that's why, even if there's some downward pressure on prices, which there will be with lower demand, it's not going to be great because we're working with a shortage of inventory.
Right. So as we talk about the economy, and we're going to switch gears here a little bit and talk about the overall economy and perhaps the impact that slower home sales, as you know, it's a huge part of the overall economy. How much does it have to slow until the Fed says that's enough?
Well, the hope and expectation is that it doesn't have to completely collapse. And there is good news, because right now, because of the shortage of inventory, we're not likely to see something like during the global financial crisis. But it's not just housing. And if you look at the residential market, it's a little over 5% of the overall economy. But it's not just housing. It's also other interest-sensitive sectors, like the auto sector, which also has a shortage of inventory. And that's one of the reasons why the Federal Reserve is raising rates so aggressively. But as you branch out, you got to keep in mind that higher interest rates impact personal loans. At some point, they're even going to impact companies borrowing money. So yes, the Federal Reserve will have to raise rates. The good news, Phil, is that if you look at a lot of measures of inflation expectations, whether it's a sophisticated bond market, what the bond market thinks inflation is going to be 5 years from now in terms of annual increases, or you look at the consumer confidence numbers 1 year ahead, all those inflation expectations are coming down. And finally, the Cleveland Federal Reserve puts out a inflation expectations number 2, and even that one is pulling back. So if inflation expectations pull back a little bit, the Fed won't feel as though they have to really crank up interest rates so much that they will kill this economic expansion. Maybe a mild recession, but they don't have to give us something like the Great Recession or even as deep as we experienced during the Great Virus Crisis.
Okay, we're going to call you optimistic, Anthony Chan. Thank you very much.